Hi everybody, Dave Sullivan here for the MMLA Membership Committee with
Paul Traub from the Federal Reserve Bank of Chicago out of the Detroit branch.
Great. Paul, thanks for having us out today. It was really nice to get out to the Fed, have our board meeting here, and have a nice lunch over there. What was some of the main points that you brought up during your speech today?
Well, I tried to talk to the audience about the recovery, where we are in this cycle, and how long this recovery has taken to take shape. We are a number of quarters after the recovery started in the middle of 2009, and total GDP is still only 2.5% above its previous peak. When a normal recovery, you'd be 16 to 17% above that.
Right, so we're, the lag is taking a lot longer to kind of get back to where we were. What are some of the things that you think that could come into play that could turn it around or increase it? I know you had some projections of 3% versus 5% or 2%. What do you think what will it take for us to kind of get back on track?
Well, what I tried to show with those is different scenarios of growth rates that would get you back to the potential output that this country is capable of doing if it was fully utilizes its human capital and its other capital and resources. We're capable of producing about 5.5% more output than we currently are. And so different trajectories of growth would get you back to that capability at different points in time. What's going to drive that right now really looks at the investment side, business investment as well as residential investment.
Okay, so I really like the fact that you kind of pointed out that the replacement cost is still significantly higher than you can buy a home, and hopefully that will spring back to equilibrium at some point. But that is another reason for home values to continue to increase, correct?
Yeah, well, there's a couple things in play that are going to help home values. One is since the bubble started, or the crash began, we continue to add population. I mean, households are continuing to form at about 1% per year. You're talking about 1.2 million kind of growth in households. They need some place to live, and if they can't buy, then they're forced to rent. So another thing we looked at was, well, what's happening with rents versus ability to buy. So if you take comparable CPI for ownership versus CPI for renting costs are going up faster than the cost to own.
Right.
So those are big drivers behind the decision process that an individual will go through before they decide to buy versus rent. But what has to happen is that the financial markets need to become more willing to make the loans, and what that hasn't seemed to take place yet. And that's what shows up in this replacement cost versus the cost to buy. If people can't get loans, you're not buying off the excess stock, right. And supply and demand model kicks in, and so you have more supply. Even though you have demand, you can't sell it. So people end up renting and paying more to rent. But the cost of building a structure still remains high because you have to buy wood and concrete and labor. And those are global commodities that trade in global markets and have global prices set to them. So if you look at the cost of building a structure versus buying a used structure, it costs so much more to build. Right. And so that's driving up rents, because if I'm going to build a rental structure, I have to build it at ongoing costs, current costs, and so I have to rent it at those costs. So that's why you see rents rising faster than ownership.
And then the last thing I wanted to talk about, you had a graph up there of when the Fed members were kind of projecting on increasing rates, and I noticed that it was 15. Most people voted for 2015 before they would expect to increase rates, correct?
Right. Well, that ties back to the transparency of the Fed to tie interest rates to full employment. The Fed has faced a dual mandate. And dual mandate means to control inflation. We stimulate the economy, but we have to control inflation and help grow employment. Right. And so that would indicate that most of the FOMC members think that it'll be until then when employment levels will get to where unemployment rates are down around 6.5%.
Great. Okay, well, again, we really appreciate you having us out here.
It's our pleasure.
And hopefully we'll see you again next year.